El gran encierro del 2020 y todas sus consecuencias económicas nos recordaron que nunca terminamos de entender cómo construir escenarios de riesgo capaces de adaptarse a condiciones inesperadas. Es un honor presentar la conferencia magistral Embracing Innovation in Risk Technology to Thrive in 2021 and Beyond, ofrecida por expertos de SS&C Algorithmics. Dimitri Van Pope dirige un equipo de especialistas en riesgo cuantitativo dentro de SS&C Algorithmics. Es experta en riesgo de crédito de contraparte y mercado, XVA y regulación. Matthew Deere es el director de ofertas de la SS&C Algorithmics, XVA Sensitives Foundation Product. Y Rafael Mendoza Arriaga es el matemático principal en la SS&C Algorithmics. Y a todos les damos la bienvenida. We welcome Dimitra, Matthew, and Rafael to the Risk Management and Trading Conference 2021.
Hello, everyone. Thank you for giving us the opportunity to present at the Risk Management and Trading Conference today. It is our honor. I'm Dimitra Bampu, and together with my colleagues Matthew Deere and Rafael Mendoza Arriaga, we'll be doing the presentation for the next hour. We represent the Algorithmics brand within SS&C, and for those of you who may not know, Algorithmics has been in the market for more than 30 years, offering solutions to financial institutions to measure their financial risks. Our clients are global banking institutions, asset management firms, hedge funds, and insurance firms. What we would like to present to you today is an overview of what we are seeing as emerging trends within the risk management space and how we in SS&C are applying technology and innovation to solve some of these problems and help our clients manage the risks more efficiently while reducing costs and overhead. Next slide, please. So, in terms of what we're seeing in risk management world today, we see that there is a convergence of buy-side and sell-side regulations. Well, the trend of the previous decade was that regulators around the world, they were asking the sell-side institutions, banks, to comply with an increasing amount of regulations. We saw many updates on the available methodologies that banks had for calculating their capital, both for market risk, credit risk, operational risk. The regulators asked the banks to add new capital calculations and new capital requirements around liquidity risk. They asked banks to apply floors on the regulatory capital, and they also asked them to participate in huge annual stress testing programs. And all of this was a response to the global financial crisis. Well, now in this new decade, what we're seeing is that regulators are shifting their focus from the regulation of the sell-side institutions into the buy-side institutions. We're seeing new regulations being introduced, such as, for example, the one introduced by SEF, the 18F-4 regulation, which is concerning registered funds use of derivatives. We see a new regulatory requirement around liquidity risk reporting for hedge funds. This is now putting a lot of pressure on buy-side institutions so that they put new solutions in place in order to comply with these new regulatory requirements. Risk data aggregation and integrated risk reporting, these are concepts that have been around for almost a decade now, but still we see firms that are struggling to bring everything together, to have a single integrated risk reporting platform that will allow them not only to have a holistic view of the risk at the top of the house, but there also is going to allow them to drill down and see the detailed risk reports across all the reporting lines. And this is actually a prerequisite if the firm wants to be able to manage their balance sheet more efficiently, and ultimately their goal is to optimize their balance sheet. We see the need for real-time stress testing. There have been many events, especially the last few years, where markets are fluctuating a lot, even during the day. Firms need to be able to revalue their portfolios in real time during the day, as well as be able to stress their portfolios in real time if they want to be able to hedge efficiently those intraday risks. Another trend that we're seeing is that investors are looking for enhanced yield after spending all these years in these very low interest rate environments. And thus we're seeing we are seeing them investing in these new alternative investments, asking their investment managers to invest in ESG compliant firms, and the risk systems need to adapt to be able to calculate risk on these investments in order to be able to capture these ESG requirements. Inflation has also started to make its way back into the major economies. This is due to the pandemic. We're seeing a shortage, for example, in major commodities and raw materials. One example is a shortage on granite, which is affecting basically the manufacturing of electronic chips, and this is driving their prices up. And as you all know, inflation is putting pressure on those buy-side institutions, especially pension funds, insurance firms, in order to be able to match the yields and the future required cash flows that they have. We also notice that many non-financial risk factors are emerging, and they start to affect the investment strategies and the portfolios of the investors. One example is, the global pandemic that we all went through this last year, and we're still going through. We also seen the importance of the reputation risk and how this is affecting the investment strategies. So we in risk management need to update our models. We need to devise models in order to be able to capture those risk factors and ultimately stress test those risk factors. And putting all of this together, there is also pressure to reduce the total cost of ownership and move all the risk technologies and the infrastructure to cloud. Next slide, please. So with all these risk management trends and the needs that we see around us, here in SS&C Algorithmics, we believe that investing in technology and innovation is very important, and this is actually what we have been doing all these years. So today we take this opportunity to present to you some of these latest innovation projects that we've been working on. We're going to be discussing with you the user experience. User experience has been around for many years, but what we're now doing is that we focused on delivering business-driven interfaces to our users. We have redesigned our decision support tools to enable our users not only to achieve integrated risk reporting, but also giving them the capability to be able to do real-time what-if analysis across all areas of risk that is affecting their portfolio, everything driven from the same interface. We're going to be discussing about non-financial risk factors. Well, this is actually a collection of research projects that we've been doing for a few years now. What we've done is actually we productionized and we launched a new product at the beginning of the year, which we call the Scenarios as a Service. So what we do with this product is we offer stress testing scenarios that capture a variety of different risks, non-financial risks. For example, the global pandemic risk, extreme scenarios, sentiment risk. We've derived models on how we can translate these risks from the non-financial risk factors into the financial risk factors so that our end users then, they can use these stress tests to process them through their portfolios and they can see the impact on their P&Ls. And this is basically the focus of my colleague's Rafael presentation. Another topic that we'll be discussing today is a highly innovative project. This started off as research, and now what we're able to do is we're able to calculate in a very short amount of time thousands of XVA sensitivities. This is basically a front office requirement that started from XVA traders. Where we are at the moment is we're able to generate 200 sensitivities in less than 5 minutes for a large portfolio of almost 100,000 trades. All of this running in a very small grid. We can achieve this by these ultra-fast simulators that we have produced using state-of-the-art technology, and we can deliver the necessary performance. More on this topic is going to be covered by my colleague Matt. But before I pass it on to my colleagues, next slide, please. What is our innovation around user experience? We've launched the last few years a new product which we call the Algo Workspace Analyzer. And it's actually a true in-memory technology that allows the users to aggregate data from multiple sources. Due to the in-memory design, all calculations and analytics are performed in real time, nothing is pre-calculated, and all the reports and the visualizations are updated on the fly as the user navigates through the different reports and through the different levels of the data. The user is able to slice and dice the data. They can group the reports across custom dimensions that they can define on the fly. This application has been designed in such a way so that it can run on a distributed grid environment, and it is very scalable and resilient. But what we have also achieved with this technology is that we are now offering our users a holistic approach to aggregating their financial risk. Algo Workspace Analyzer can aggregate data and report risk across all areas of financial risk. The same application can be used, for example, by C-level execs. They can create their different reports. They can see top of the house aggregated results across all their business lines and across all the different sources of risk, for example, market risk, FRTB, CVA, as well as credit risk capital, ALM, and liquidity. For more advanced users, such as, for example, the risk managers and the analysts, they can use the same application to define reports that are very, very granular. They can drill down and slice the dice, all the different calculations, so that they can identify the sources of risk and attribute that risk to the positions in the portfolio, to the risk factors in the portfolio, so that it can allow them, they can actually use this information to go and hedge their portfolios. And that same technology can also be applied across other areas beyond financial risk, because the application is fully extendable and it's easily programmable so that our users can define their own risk analytics, their own financial analytics, and beyond if they wish. Next slide, please. And so together with the integrated risk reporting application, we have also done a major investment into how our users interact with the algorithmic solutions, and we have actually come up with what we call the Algo Risk Manager. This is more of a business orchestration application. It's a tool that empowers the business users to perform ad hoc analysis. They can actually do what-if analysis, and they can get access to all sources of financial risk. It's an easy-to-use web-based application, and they can define, for example, what-if trades. They can upload a hypothetical portfolio, and with just a few clicks and a few buttons, they can run this small batch process, and they can calculate these incremental risks, and they can see the impact on their portfolio. All of this without needing to involve any IT people. All these results are automatically reaggregated, and using the Algo Workspace Analyzer, the users can visualize the impact of this hypothetical portfolio on their P&L and other limits. So there is any aggregation as well between the Algo Workspace Analyzer and Algo Risk Manager. With the same application, what users can do is they can perform amendments, they can fix data easily without the need to involve IT. They can change the product definitions, they can run scenarios and different modeling assumptions. What if, for example, what would be the impact if I change the model of a particular derivative transaction? And what would be the impact in the portfolio? They can also define new stress scenarios on the fly, and using the same interface, calculate real-time what is the impact of these stress scenarios on the firm's portfolio, or even a subset of the portfolios. They can upload new market data and run intraday patches. And again, the emphasis here is that all of this is driven by the business user. No need to call IT to do this, these tasks. Again, this application is available for both trading book risk and capital solutions, as well as banking book solutions. So again, a holistic view on risk and what our users can perform with our technology. So with this, I would like to pass it on to my colleague Rafael, who is going to give you an overview on the research that we've been doing on the non-financial risk factors.
Next slide, please. Hello, good morning, everyone. Hola, ¿qué tal? Mi nombre es Rafa Mendoza. I'm the head of quantitative research at SS&C Algorithmics. And the purpose of this talk is to present you the scenarios as service, which allows to have a framework for a new class of scenarios. Next, please. Yes. So the purpose of this scenarios as service is to be able to model extraordinary events, literally out of the ordinary events. For instance, we have the ongoing pandemic events, which has shown us that extraordinary or out of the ordinary events can occur. Unfortunately, it has not only affected um, our markets, but most importantly, it has affected our families, our societies. Nonetheless, in the area of financial market, it has taught us that we have to be more responsive to new events. And this has put us into modeling stuff which is outside of the financial realm. So these pandemic scenarios are based on epidemic models for COVID-19. We also present hypothetical scenarios, which allow us to model extreme yet possible tail events. And lastly, we'll mention a little bit on sentiment-based scenarios, which is an ongoing research in where we try to capture the behavioral response of investors given different news. Okay, next, please. Let me begin with the pandemic scenarios. By now, we are convinced that the pandemic crisis has had an effect on financial risk markets around the world. For instance, in this example, let's consider the following two graphs. On the left, I have the log of the natural log of the number of cases in the US and in Canada. The US is in blue, Canada is in red. From the beginning of the pandemic, which in North America, we can say is the end of February, all the way to mid-June in 2020. On the right-hand side, this chart represents the index level of, here is the S&P 500, the index price level for the same period of time. One thing we can notice is that on the right-hand side, the arrow indicates when the US and Canada start implementing social distancing policies. Since these lines, or the natural log represents the exponential growth of the number of cases, we can see that as soon as the social distancing policies were implemented, we changed from a high growth rate to a lower growth rate in the number of cases. And that was taken very positively in the financial markets, this among other things. We can see that at the beginning of the pandemic, the stock market, as is represented here by the S&P 500, started going down drastically. As soon the implementation of social distancing start being announced, the market investors reacted positively or more optimistic, and we saw the market going up again. And this is not something that only happened in the US. It also happened in Canada. Next, please. Here is the representation of the TSX index. Next, please. And this was repeated all over the major economies. Please go back. Yes. So we can see that there is a link, okay, between non-financial data, which are the pandemic statistics, and financial risk drivers. So if this type of link exists, how do we make the connection? How do we put this link in mathematical terms so that we can generate the scenarios? Okay, and first, or more fundamentally, we need to be able to forecast non-financial data. In this case, how can we model the pandemic dynamics or evolution? Next, please. Next, here. That led us to think about epidemic models. We are going from the financial realm to an area that is beyond finance. Now we're talking about epidemic models, and this is a very famous model called the susceptible, infected, recover, and death epidemic model. In this model, we set apart the whole population in 4 different groups. The first group are the susceptible people, the amount of the population or the part of the population who can be infected with the disease. Okay. The second compartment or group is the infected people, the actively infected people, and therefore that people is contagious. The next group, we have the recovered, people who have had the infection and they have recovered, and we assume that these people become immune. And the fourth group is the people that unfortunately has succumbed to the disease. People who was from the susceptible group, got infected, and from being infected, unfortunately, they died. Okay. Once people die or is recovered, the assumption here is that they cannot get infected as well, again, so they do not form part of the susceptible group anymore. Next, please. The quantities under the arrows represent the transition rates. For instance, ds over dt is the transition rate from the group of susceptible to the group of infected. Beta here is the transmission rate. Then similarly, we have the transition rate from the infected group into the recovery group, which is given by dr dt, where gamma is the recovery rate. And from I to D, that rate is given by d over dt, where eta is the death rate. Okay. Two things I want to notice in this model. This model is very typical in epidemic formulation. However, given the nature of the pandemic at the global scale, we need to make some assumptions. First is that the rates are not constant. We will have to modify those rates, beta, gamma, and eta, over time. So now the problem becomes a time-dependent process. And if you see at the rates, they depend on S and I. What it means is that, for instance, when it depends on I, is that the higher the number of infected people, the rate of people dying is higher, and also the rate in which people move from the infected to recovery is also higher. Again, by having I in the transmission rate, we can see that the higher the number of people that is being infected, the more likely they will infect other people, and therefore the rate going from susceptible to the infected group increases. It also depends on S, that particular transition rate, ds over dt, because the larger the population, okay, the more likely that people are in contact with the infected part of the population, and therefore you have a higher rate of infection. So that's why social distancing and curfew tries to limit this transition rate at this level. Okay, it's not in the recovery, it's not in the number of dead people, but in the infection rate, the transmission rate. Okay, next, please. Now, as I mentioned, we needed to consider the fact that the rates are time dependent. Why is that? Because it is true that at the beginning of the pandemic, we knew very little of where was it coming from, what was the implication, what was the rate of transmission, what was the fatality rate or death rate, and how much time it would take to recover. So at the beginning, you have more uncertainty than at the end. Moreover, we have less tests. We didn't have enough tests to be able to represent with certainty what these transmission rates are. Also, these are time dependent because different governments have applied different health policies at different periods of time. So the transmission rate from Canada, it's not the same as the transmission rate in the UK or Germany, because the policies were implemented at different periods of time. So we need to treat each of these populations separately. Now, also, as time passes, medical doctors have been able to develop better treatments over time so that more people can recover. We have also developed vaccinations, so a less number of people are getting infected, and if they are infected, they are less likely to die. So therefore, as these new policies, as these new advancements in medicine change through time, we need to adjust our model. And obviously, we also have another reason for treating these rates as time dependent, because we have the second, the third, etc. waves over time. Okay. Now, this is not an easy model. This is not an easy type of data we need to model. So we need a model that is flexible enough and simple enough. And this model for us was able to do both. If you go to the next slide, please. So we can see that we can have almost a perfect match for Canada. On the first top left corner, we have how the number of susceptible people has evolved over time from the beginning of 2020 until the beginning of February 2021. The top right group is the people who have recovered. The bottom left is the people that is currently infected during that period of time. And lastly, we have the number of people who unfortunately has died on the bottom right of the graph. You can see that these are very non-linear time-varying data sets. But we are able to capture these with a very high precision. If we move to the next slide, we can see that this has also been the case for the US, next, UK, next, Germany, next, etc. So now we have decided in which epidemic model we can use in order for us to be able to describe the dynamics of the pandemic data, and therefore to a forecast of where the pandemic numbers will be the next week, the next month, etc. With certain certain accuracy. Okay. Now, once we have the evolution of the pandemics, we need to be able to link those statistics or that data into financial risk factors. So we decided to go with a more simple approach, and this would be done by a regression model. Okay, the first term is the natural log of the price of the index of interest, say the VIX, the S&P 500, DAX, FTSE, the TSE, you name it. Okay, so we have as y of t the natural log of the price. Recognizing the fact that there is a momentum, okay, we have included an autoregressive term. Why? Because as we can see is that if people are worried today, investors are worried today, or have a pessimistic view today, most likely they will have a pessimistic view tomorrow. And vice versa, if they have an optimistic view today, they will have an optimistic view tomorrow. And these views are mainly driven by information that comes from government policies, implementation of policies, or by updates in the epidemic data numbers or statistics. So we need to be able to capture this momentum. The second is the real epidemic data. Therefore, we have epidemic terms, which are transformations of the epidemic variables in the epidemic model, which are the susceptible group, the infected group, the recovered group, and the death group. Epsilon is an error term, the residual term. If you move to the next slide, please. Okay, so doing this, we look at how well we are able to match the financial data. And we can see that we have a very high percentage of variation described by this model. For instance, 92% of the variation is being explained by this model in the case of the VIX, 96 in the case of the S&P 500. If you move on to the next slide. Yes, we have a little bit less accuracy or variation explained in the case of the S&P Real Estate Index, which is 88%, and 94% of the variation being explained for the financial index of the S&P 500. Okay, if you move the next. So now we have been able to describe the epidemic dynamics, and we have made a linkage or a connection between the epidemic data and the financial data. How can we use this to generate the scenarios that will be able to describe what would be the index levels in the near future? 1 day, 1 week, 1 month. Okay. In order to do that, we make use of the regression equation or regression model that we have in the top equation. So we can recover the price. And as you can see, once we are able to simulate the epidemic variables, which we do it using a Poisson process, then we can simulate the price conditional on the previous simulation of the epidemics using a normal distributed random variable that will describe the behavior of the regression error. Could you move to the next slide, please? And here I present some examples of the Monte Carlo simulation. Here I'm just plotting different quantiles, not the full set of scenarios, to represent where our models or how the distribution will look in 1, 5, and 10 days. Okay. Now the real question, or the next question, which is a fair one, is how good are these scenarios? So let's look at it. We move to the next slide. These graphs, what they represent is what is our 1 day, 5 day, or 10-day forecast of the price level, in this case of the VIX. And that is represented by the blue line. That's the expected value. The dashed lines around the blue line represent our confidence. Here I'm presenting 97 and 99.5 confidence intervals for 1 day, 5 days, and 10 days forecast. You can see that as we extend our forecast horizon, the confidence band increase naturally. And the red dot is what really happened on that particular date. What we predicted, what really happened, and what was our confidence. And we can see that our forecasts are quite accurate, and we only violate the confidence band only on a very few periods of time or points. And this has been a process that we started in April of 2020, and here I'm presenting everything up to the February 2001. These are real data and real forecast of our model during 1 year, almost 1 year of process that we run daily. Okay, so we believe we're doing a pretty good job in that case. Now, if we move to the next slide. Okay, the next set are called the hypothetical scenarios. These are a new class of stress test scenarios that will allow us to capture extreme yet plausible tail events. We'll move to the next slide, please. Okay. Why we need hypothetical scenarios? Well, first of all, it is a new requirement, the 18F-4 requirement of the Investment Company Act, which is explicit in asking us stress testing for extreme but plausible market changes that take into account the correlation among factors. Correlation is a very important fact in this framework, and that it has a minimum frequency of weekly runs. So we need to be able to do this daily, basically. Okay? Standard methodologies do not provide us with a coherent solution for these multidimensional, extreme yet plausible stress test scenarios. For example, historical and traditional Monte Carlo scenarios will have a hard time to be able to describe a 1 in 10 year crash or rally that combines the S&P 500 with the US Treasury crash or rally, because going into a crash of S&P does not necessarily mean a 1 in 10 year crash on the Treasury or a rally in the US Treasury. However, our methodology is able to capture the 1 in 10 year simultaneous crash and rally event for both the S&P 500 and the US Treasury. And this is obtained by using a very simple and basic concept of principal component analysis. If we move to the next slide, please. Okay, so I already mentioned that historical Monte Carlo will have a hard time to do this, mainly because historical relies on data on events that have already occurred, but those events may not be relevant today, hence they cannot model whatever has not happened in the past. On the other hand, Monte Carlo stress scenario, you have to make a very sophisticated assumptions on the dynamics of the underlyings, enabled to be able to capture heavy tail events. And in order to do that, we have to do it in a correlated way, multidimensional way. So we will have to request a large number of costly repeated evaluations. Okay, so if we were able to create a cost-benefit table, we can see that in terms of model complexity, historical is very easy or has a low complexity. Monte Carlo would be high, and our case of hypothetical would be medium. In the case of computational cost, historical would be low, Monte Carlo would be high, and hypothetical scenarios will be low. With respect to the tail coverage, historical has a medium coverage, Monte Carlo usually has low, and hypothetical has a very high tail coverage. We move to the next slide, please. Okay, so let's first of all talk about the definition of extremeness. Okay, extremeness is basically given by the event whose probability of occurring is 1 in n years. And under normal circumstances or under the normal distributed assumption, this occurs by obtaining the probability of an event occurring after a number of standard deviations, such that it occurs 1 in 1 year or 1 in n years. However, if we move to the next slide, the normal distribution is not a very good assumption. Next, please. Next. You can see that the tail distributions are not being captured properly. Next. And I'm sorry, I have to rush now because I have very little time now. So we can see that over time, if we use the normal assumption here, we will be underestimating the returns and the both in the left and the right tail. And this can be accentuated over different crises, like in the financial crisis or the COVID crisis. Next, please. Next. Okay, so we need to look at different distributions. And here I have several distributions that can be good candidates. I'm just going to emphasize the generalized hyperbolic distribution. You move next, please. And you can see that this distribution can do a better job on the tails. They fit much better. Next. So I would like to have more time to explain this a little bit more careful, but basically what I want to describe here is that we need to use heavier tail distributions rather than the normal assumption to describe the returns of different events. Next. These distributions are able or more capable to manage tails, as you can see in the financial crises of 2008 and the COVID crisis. Next, please. Okay, so here is the key point of the hypothetical scenarios. Having heavy tails distributions in one dimension is a simple task. We can calibrate different tail distributions. The problem is that once we want to move to the multidimensional approach. So for instance, how do we model two factors? Say, for instance, the S&P 500 and the FTSE factor. They have correlation. If we would like to measure a 1 in 10 year event, we can see in this graph that everything that is in the most outermost, the most outer contour of this distribution will represent any event that can occur 1 in 10 years. 1 in 10 years. Okay, but which event should we choose? Okay, because all of these are valid, but it becomes very difficult to describe which of these we should use. So the idea here is, why don't we choose that one point that explains the highest variation? And that is given by the first principal component. Next. So that will be along the axis of highest variation. And that's the extreme event we will do. In that case, we can represent 1 in n years event or extreme event that is able to capture the codependency among factors. Next slide, please. So we have different type of groups that will be considered as primary drivers. We have from developed countries to developing countries. We have interest rates, FX, credit, commodity, volatility factors. Next, please. As you can see, we have the time series of all of these factors here. So another benefit of this approach is that it will allow us to slice and dice according to different factors and different periods of time as we please in order to represent, for instance, a North American extreme yet plausible event or a European extreme yet plausible event in the interest rates, etc. So move to the next slide. And we can choose different periods of time. And here would be able to choose the financial and the pandemic crisis solidly. Next. Different indices. Next. And any slice and dice. Next. So currently we have 29 different drivers that we use, and we have different primary driver sets, which are described here. for different events like developed countries, European market drivers, etc. Next, please. I will have to skip the sentiment scenarios to give some time to my colleague Matt. If you can move next to Matt, or to the presentation of Matt. Go next. There. Thank you.
Okay, thanks, Rafael. So in this last section, we just want to talk a little bit about the business area of XVA sensitivities, the business problems, and why SS&C Algorithmics have spent some time investing in new technology to help solve these business problems. So in the interest of time, I'll go quite quickly through these slides, but we can always organise other sessions afterwards to drill into more detail. So next slide, please. And again, next, please, sorry. Great. So just to quickly outline the business problem that we're facing. First of all, XVA sensitivities, what are they needed for? So firstly, there's a regulatory requirement, of course. So the CVA capital part of the FRTB regulation. There are two approaches that can be used, a basic approach, which is quite punitive in terms of capital, and the standardized approach, which requires the calculation of XVA sensitivities. Now, the exact number of sensitivities depends on the products being traded and the number of currencies, things like this. But typically, the banks that we talk to, they need a few hundred sensitivity calculations to be able to calculate CVA capital. Tier 1, Tier 2 banks will often have XVA desks in place, and for these, many thousands of sensitivities may be required in order for them to be able to efficiently hedge risk. Modelling requirements, initial margin now needs to be determined forward through time for both centrally cleared and OTC derivatives. And the number of XVAs themselves seems to always be increasing. You know, historically we've had CVA, DVA, FVA, now MVA, KVA are becoming more prevalent, and there are even more coming down the line, such as HVA, or hedging valuation adjustment. So in summary, a huge increase in computational requirements that can't be solved using traditional techniques. So next slide, please. And again, next slide, please. So what has been Algorithmics' approach to this problem? Well, we've actually invested in a new generation of simulation and aggregation technology. And the first fruit of this is a product that we've called XVA Sensitivities Foundation. So this tool enables a high performance calculation of both the baseline XVA measures and all of their sensitivities required for both the regulatory reporting and for a front office XVA desk. So what we've actually done is we've actually written or created a new language. We've called it Boxy. So it looks very much like C, C++. And we can use this language to capture the pricing, the payoff logic and the aggregation logic that we need in order to be able to calculate the XVA and XVA sensitivities. Now, we use a number of sophisticated optimization techniques to get this performance acceleration without any additional hardware. And the next couple of slides, I'll just drill into a couple of these techniques. So next slide, please. So chiefly amongst these, obviously, is automatic differentiation. What do we mean by that? We mean building differential calculus into your code so that you can calculate the differential of the XVA with respect to the input risk factor, and that gives you the sensitivity. Now, this kind of technique, the AAD, has been around for quite a long time, but we believe the way that we've implemented it is quite unique. We've actually built the calculation of the differentials into the compiler. So when a person is building a new product into the solution and they're putting together, the pricing, the payoff, they don't have to worry about the calculation of the differentials. That's taken care of for them in the compiler. And because it's done in the compiler, it leads to an extremely efficient implementation of AAD. Next slide, please. So another technique that we've relied upon is we call it smart simulation, but effectively what we've done is the tool that carries out the XVA sensitivity calculation runs in two parts. There's a scheduler part that examines the data and determines the best way to break up the calculation across the compute nodes. And then there are compute nodes that actually do the heavy lifting. They're the ones that will actually simulate the trades, aggregate them, and calculate the sensitivities. Now this is completely dynamic. We can run this on premise, but we can also run it on a cloud environment as well. And the scheduler will dynamically balance the jobs between the compute nodes. If you're on a cloud environment and you decide to dedicate a new compute node to the calculation, the scheduler will detect this and it will rebalance the calculations across the available compute nodes to ensure that everything completes in the minimum amount of time. The scheduler also maintains what we call cost models, which is it uses to break up the calculation across the different nodes, and it continually updates these every time it runs. So it's almost as if the application is learning how to best break up the calculation across the compute nodes every time it runs. Next slide, please. So what are the results of this kind of technology? The proof is in the pudding. How quickly can we get this to run? So as my colleague Dimitra mentioned at the beginning of the presentation, we've done a number of proof of concepts with different clients. Typically, the clients that we work with tend to have around 100,000 trades in the portfolio. So we did a proof of concept with one of our European clients, 100,000 trades across 18,000 legal entities, and we configured the calculation to calculate around 200 sensitivities. And we ran it on a fairly small grid, 132 cores. And as you can see, we can run the whole calculation, the calculation of all the XVAs and the XVA sensitivities in less than 5 minutes. So a phenomenal increase in performance, and we're talking near real-time calculation of sensitivities. So next slide, please. And then again, sorry, next slide, brilliant. So what are the business benefits of this new technology? Well, there's three really. Obviously, firstly, there's the regulatory compliance, need to be able to calculate CVA capital, but also competitive advantage. As everyone's mentioned, there's been a lot of volatility in markets over the last 15 months or so. If you can calculate all of your XVA sensitivities in near real time in a matter of minutes, that gives you a huge competitive advantage. You can rebalance your portfolio very, very quickly, re-hedge. And obviously, a big factor these days is cost. Banks are looking to keep their costs down, reduce total cost of ownership. As I mentioned with this technology, we ran it on a fairly modest grid of 130 cores. So this technology, it actually enables you to reduce the amount of hardware that you need to dedicate to your XVA calculation. And then finally, next slide, please. So just to quickly mention, we carried out a proof of concept with one of our European clients. At the time, as I mentioned, they had 100,000 trades in the portfolio. They had a grid of 4,000 cores that was required to calculate all of their XVA sensitivities. We can reduce that to 120, 130 cores, so a 97% reduction in hardware. The batch time, typically the batch was run overnight, 5 or 6 hours. We can run it in 5 minutes, so we're talking a 95% reduction in batch time. And typically many banks using a bump and run approach for calculation XVA sensitivities will do 10 to 15 sensitivities per night. Using this technology, we can do 200-300 sensitivity calculations in minutes. So really threefold benefits to this technology. Increasing the number of sensitivities, we can do it in near real time, gives you banks huge competitive advantage in times of market stress, and reducing total cost of ownership, a massive amount of reduction in the amount of hardware that's required to run these calculations. And the final point I'd just like to make is that this new technology that we've developed is completely independent of the other algo products. Obviously, we can leverage this technology with algo products, but for any bank that's wishes to try this technology out, we can make it available via cloud, and there's no dependency on any other algo products. So short and sweet, I just got through those slides, so now I'll hand back to Dimitra, I think.
So thank you very much for listening to our presentation, and I think we have a couple of minutes for questions if there are any.
Well, thank you very much. Thank you, Dimitra, Matthew, and Rafael, for your presentation. We have indeed some questions. They have arrived, but the problem is that time has gone, and as you know, we have a panel in a moment. I just would like to ask you whether this trend of soft issues, perception, confidence, it will be the trend for the rest of the time. It will evolve in that way, or we will get back to the traditional models with less soft issues to evaluate the markets. Matthew.
Raphael might be the best person to answer that one.
Should answer this. So yes, I think that there is room for both approaches. No, it is true that with the newer flow of information that we can see in different venues, even from Twitter to more sophisticated financial reviews, by having that data available to us, that creates more of an impact in the financial market. So we still need to be able to capture these soft issues, if we would like to say. Now, events such as a pandemic, I mean, this is something we haven't seen before, but now we need to consider what could happen if this happened again, if a new pandemic occurs. What if now it is more about climate? What if now it is more about other issues that may affect the financial markets or disrupt the financial markets? So there is a trend now, like with ESG policies, with climate change, now the pandemic, that now we need to go and focus on non-financial data to describe possibilities.
Thank you. Absolutely a great exposition. SS&C Algorithmics, you really give us a great opportunity to the whole financial sector in order to prevent, in order to forecast what is going to happen and be able to have all our customers in the best condition for the profitability of their investments. Thank you very much to the three of you. It has been a pleasure to have you with us.
Thank you.
Thank you.
Thank you.
Thank you.
And thank you again. And thanks for being not only for them, to all of you, the ones, a todos los que están con nosotros en estos momentos, siendo parte del Risk Management and Trading Conference 2021.